Good day friends. In the lecture series on retirement planning, in today's lecture I will be talking about what are the factors which you will consider while taking a pension plan, and I will be talking about the different specific pension plans that are available in India. Broadly, I will say that when you choose a good pension plan, it depends on three things: the timing, variability and coverage. Let me talk each of this. First of all, timing. The timing means that whether you want that your pension should start immediately or you want that after a period of time the pension should start. When you want that pension, you should get a pension. When I am talking of retirement plans or pension, see, normally when we talk of the pension, it means that we want a regular flow of income after our working life. Normally, even sometime, people in the age of 50, when they start their job and they want that in the age of 50 itself, they should get, although they are working at that stage, but apart from the salary income, they should get some extra regular flow of income and they start making investment at the age of 25 itself. So, timing, when you want to have a pension, when you want to have that regular annuity income, so either it may be you want that immediately it should start, or it should start after a period of time, after 20 years, after 30 years, or when you will not able to earn, at that time it should start. So that is basically the timing aspects. So if the policyholder wants annuity payment to start immediately, then immediate annuity plans to right choice. I discussed in my previous lectures about the immediate annuity plan, that is you deposit a lump sum money, say for example I deposit 5 crore rupees, and with this 5 crore rupees I will be depositing with some pension fund or pension fund manager, I would say, and immediately some monthly income will start. I want that I should get a regular income. So the fund manager, the pension fund manager will invest my 5 crore rupees in some schemes as the plan which I have taken, and from that income that will be generated by this 5 crore rupees of investment, a monthly money will be given to me. So that is basically if you want immediate annuity. However, if regular pension payment are desired after retirement, then one should go for a deferred annuity plan, right? So I want that not today. I am supposing I am 50 and my working life is another 10 years. So after 10 years my pension should start, after that annuity income should start. So I will take deferred annuity plan. So there are two types of plan. One is called the immediate annuity plan, that is when you want that immediately pension should start the moment you make the investment, from the next month the pension should start, or if you want that the pension you want after a period of time, say after 10 years, 15 years, 20 years, 30 years, then you should take deferred annuity plan. The choice also depends on the age at which the pension plans are bought. This age is very, very important. If one has just started the career, the deferred plan is a good one. Whereas if the investor has recently retired and have a lump sum retirement benefit, that the gratuity or the provident fund, then the immediate plan are better, right? So means at what stage you are taking the pension plan. Whether you are taking the pension plan in your working age group itself, in your life when you are in the employment, right? At that time, normally the individual prefers to take a deferred annuity plan, that the pension will start after a period of time. But if you are taking a pension plan at the time of retirement, when you are investing the lump sum money, then the immediate plan suits your requirement. The other important factors which you should consider while taking a pension plan is called variability. If the annuity amount is fixed, which is either guaranteed or not guaranteed, that it is fixed annuity, and if the annuity amount varies on performance of the underlying investment, that it is called variable annuity. I have taken a plan from a organization which is approved by the National Pension Regulatory Development Authority of India, where I want that I should get a fixed annuity amount. So if you recollect in my previous lecture, I said some people invest in the in plan where only the investment will be made in the debt instruments. Some people take plans where the company, where the investor company will be investing in equity. As all of us know, that investment in equity is subject to greater degree of risk as compared to the debt. In debt instruments, you get a regular flow of income, right? And in equity investment, your income fluctuates. See, where this body, where you have got the plan, you have got the pension plan, they don't pay out of their own pocket. They make the payments out of the income that is generated by your investments, right? So, if you want a fixed guaranteed money, then you should take fixed annuity plans. If you want that your income you can live with, if even if income varies, supposing an individual have other sorts of income also, so that individual knows that even if in a particular months or for some years my income, monthly income or the quarterly income or the biannual income comes down, then I have some other source of income, and from that I can have my livelihood, right? So those people can take higher degree of risk, and they take such plans where the income varies, means depending on underlying investment, means where the company has invested the money. I have taken a plan, say for example UTI pension plan. Under the UTI pension plan, there are two schemes. In one scheme where the investment will be made purely on the debt instruments. There is other scheme where the investment will be made purely in the equity, right? So if the individual would take debt instruments, so you can take a fixed guaranteed income plan. If you are investing in the equity, then you can take a variable income plan. So what type of the investment plan you want to take, what type of annuity you want to create, depends on your risk profile, right? So there are two types of the plans, either fixed income plans or variable income plans. Hence, an investor who wants lower risk may choose fixed annuity where the returns are low, and people who have higher risk appetite may consider variable annuities with higher returns. And the third aspect is coverage. An annuity plan can cover a single individual or joint, in which one can cover another person who would continue to receive regular annuity payment for a lifetime in a joint life annuity. I want that I am a single earning person, and I want that I should get a regular flow of income not only during my lifetime, but even after my death, my spouse should get the money. So what I will do is, the coverage is not only of myself, but coverage is of my spouse also. That is called joint life annuity. In this plan, both the husband and wife, or whomsoever you want to join, right? So depending on the company, where the company entitles you for that or not, but normally it is, I will take the example of spouse. That is spouse, both, if you are taking a joint life annuity, so both husband as well as wife, or vice versa, wife as well as husband, both are entitled to get an annuity up to during their lifetime. So coverage is of both. So annuity is first paid to the life assured, the individual who has assured, suppose husband is assured, so during his life the person will be given, after his death his wife will be given, right? So first paid to the life assured, and after his or her death the spouse of the insured continues to receive the annuity plans. Hence, if one wants to cover the spouse as well as, then they can opt for joint life annuity, so that they receive payment even after the death or of the policy holders. I have just named them for your knowledge sake, that there are some good pension plans in India called, I will not elaborate it on much, but I am just naming them: LIC Jeevan Akshaya 6 plan, LIC Jeevan Nidhi plan, right? SBI Life Saral pension plan, HDFC Life Click 2 retire plan, and HDFC Life Assured pension plan. ICICI Prudential Easy retirement plan, Reliance Smart pension plans, Max Life Guaranteed lifetime income plan. See friends, I am not suggesting to take one of these, but I am just saying this is just an indicative that these are some of the plans which are popular in India. Now I am coming to the government pension schemes. Pradhan Mantri Shram Yogi Man Dhan Yojana. I'll be discussing these each one by one. Atal Pension Scheme. These are all schemes sponsored by the Government of India. Pradhan Mantri Vay Vandana Yojana. Employees Pension Scheme, which is normally known as EPS. Senior Citizen Saving Scheme, right? SCSS, Senior Citizen Saving Scheme. National Pension System. Now coming to these plans. First, Pradhan Mantri Shram Yogi Man Dhan Yojana. Mantri Shram Yogi Man Dhan Yojana is a government scheme meant for old age protection and social security of unorganized workers. Friends, for a quite period of time in India, there was pension plan for government employees, even for the private sector. There was some form of social security in form of the provident fund amount and other funds. But those who are working as an unorganized worker, suppose the maids who works in a home, the daily workers, the construction workers, right? And there is a whole lot of unorganized workers in India. During their working life, they earn the money, they have their livelihood. But what after, once they are not in a position to work, to earn their livelihood, what will happen to them? For that purpose, the Government of India started this Pradhan Mantri Shram Yogi Man Dhan Yojana. Right? This scheme is mainly for unorganized workers. So what is the eligibility of this scheme? For unorganized workers, I have named who are the unorganized workers. Entry age between 18 to 40 years, that person can enter into the age of 18. Any person who is up to from 18 to 40 can join this scheme. Monthly income up to 15,000 rupees, right? Your monthly income should not exceed monthly. So all these daily wages workers, they normally have the monthly income of 15,000 rupees. Not a member of EPFO or ESIC or National Pension Scheme NPS, right? So the person should be, like say, people who works in the private sector, organized private sector. So they are the employees of EPF, they are the members of the EPFO or ESIC. So these members are not entitled for this scheme. These schemes are purely for the people who work in dabas, daily workers, casual workers, maids. I mean, all these are person who works in the farm sector. There is a whole lot of workers who work in the agriculture sector, not having their own land, but they work for somebody, right? So these are people who are working in the unorganized sector. So these people are entitled for this scheme. So what this scheme, the good thing about this scheme is that's assured a pension of 3,000 rupees per month. You may say that 3,000 is a very small amount, but still something you will get as a regular income, right? So that you can have a minimum, at least your lifetime, in your lifetime, when you are not able to earn, you have at least minimum livelihood. With this, you are not dependent even for your pocket expenses, right? So voluntary and contributory pension scheme, right? This is purely voluntary. This is not a compulsory. And the Government of India doesn't force you to enter this. You enter into the scheme. You keep on depositing the money between the age of 18 to 40 years. And during that period, the contribution you will create, the Government of India will guarantee you for 3,000 rupees per month. So matching contribution by the Government of India. The amount you will be contributing, the similar amount will be contributed by the Government of India. This is a big feature, that contribution is made not only by the person who has taken this pension scheme, but it is also being contributed by the Government of India. The other scheme of the Government of India of pension is called Atal Pension Yojana. Atal Pension Yojana, formerly known as Swabhalamban Yojana, is a government-backed pension scheme in India, primarily targeted at the unorganized sectors, workers like drivers, gardeners, hosemaids, and so on. Like the previous scheme, this scheme, Atal Pension Yojana, is also for the unorganized sector. So it was mentioned in the year 2015 budget, because in the year 2015 it was being introduced. So in the year 2015, a provision was being made by the then Finance Minister, Mr. Jaitley, to start this scheme. And finally, on 9th May 2015 in Kolkata, this scheme was launched. So who is eligible for this pension scheme, this Atal Pension Yojana? The individual must be a citizen of India, must be in the age group of 18 to 40, should make a contribution for 20 years. That is, that the individual will have to contribute for 20 years. Like you join in the age of 20, so up to the 40 years, you will have to contribute. Must have a bank account linked with your Aadhaar. Right. So these days, for all the pension scheme, not only this scheme, I would say the Aadhaar is a mandatory requirement, and the individual must have a bank account, because the government no longer deals in the cash transactions. All the transaction that is being made by the government of India, that is paid through the bank. So you must have a valid bank account which is linked with the Aadhaar. Must have a valid mobile number, so that you can see the idea of this mobile number linking the Aadhaar number with the bank account is so that there is no leakage of money. The right genuine person should get the pension. The person who has contributed during his lifetime for under this Atal Pension Yojana, that's individual, the most eligible. Most eligible means the right person should get the pension amount. This is the idea of the mobile number and the bank account and the Aadhaar. And the good thing about this pension scheme is that Indian government guarantees the minimum pension that will be paid to the individual after retirement. And under Section 80CC-D, individuals are eligible for Atal Pension Yojana tax benefit for the contribution made towards the scheme. See, whatever I am contributing during my working life under this, I will get the tax benefit under Section 80CC-D. My contribution, the premium that I will be paying under this Atal Pension Yojana, the money will be deducted from a total taxable income, right? So under Section 80CC-D, individuals are eligible for Atal Pension Yojana tax benefit for the contribution made toward the scheme. All bank account holders are eligible to join this scheme. Individual will start receiving pension once they reach the age of 60. So from 18 to 40, your eligibility is 18 to 40, and for 20 years you have to make the investment. But the pension that will be starting, it will be in the age of 60. Means even if a person is of 40 years, that person is entitled to take this scheme, because he has to contribute or she has to contribute for 20 years. So anything when you start 18, earlier you start, the better it is. So, but the pension will start in the age of 60. Private sector employees who are not provided any pension benefits are also allowed to apply for Atal Pension Yojana scheme. So, in this scheme, you have the option of receiving a fixed pension of rupees 1,000, 2,000, 3, 4, 5, any amount once you reaches 60 years of age. See, how much fund you will receive, it will depend on the contribution you have made over a period of time, right? So, in case of death of the subscriber, pension would be available to the spouse, and on the death of both of them, subscriber and spouse, the pension corpus would be returned to the nominee. Not the annuity, means regular flow of income which you will be getting. Only the corpus that has been generated of your investment, that corpus will be paid to the nominee of the individual. So this is about your Atal Pension Scheme. So before the age of 60 years of age is not permitted, however, to only in exceptional circumstances to withdraw the money. So exit before the age of 60 is not allowed. So in the event of death of the beneficiary or terminal disease, right? So the money will be given when the individual become 60, right? Now, there is another scheme called Pradhan Mantri Vyay Vandana Yojana. It is called Vyay Vandana. Vyay means expenditure. Vyay is a Hindi word which is called expenditure. So Pradhan Mantri Vyay Vandana Yojana provides social security and financial independence after retirement by offering an assured rate of return on the investment. See, as you know, the rate of interest in India, or rather throughout the world, keeps on fluctuating. Up till a few months back, the rate of interest was around 4%, 5% in India. Now it is 6.5%, 7%, right? So, but there was a time when the bank used to give only 4%, 4.5% interest. Not long back, only 2 years back, or I would say 1 year back, the government of India used to give 4% interest. Suppose when I get retired, I get a corpus from my retirement. I'm a private sector employee, I get to say 50 lakh rupees. And if the banks offer me, I want that with this 50 lakh rupees I have to spend throughout my life. I have to, this is my only saving in my life, and no longer I will be getting a salary income. So with this 50 lakh rupees I have to spend my whole life. And if the rate of interest is as low as 4%, you can imagine how much income this 50 lakh rupees will generate. So there are certain schemes in the Government of India where they guarantee you a certain specific rate of interest, which normally happens to a greater rate of interest as compared to the market rate of interest. So you are entitled of a higher income had you depositing your money in the bank or some bank post office or some in these type of schemes. So what they do under the scheme, a guaranteed investment amount means a guaranteed return is being offered to the investor. Say for example, 8% is a minimum return that your investment will fetch. This is being guaranteed by the company. So this pension scheme is only offered by the Life Insurance Corporation of India and provide assured return for 10 years. According to the 2018-19 budget, government increased the maximum purchase price of 15 lakh rupees. I am getting retired and I am getting some money. So out of this money, if I deposit in a bank, I am getting say X rate of interest. And LIC, if I deposit 15 lakh rupees of my corpus in this LIC will give me a fixed rate of interest, which will be certainly higher than the market rate of interest. So what is eligibility? Applicant must be an Indian citizen, must be above the age of 60 years, should be ready to avail the policy terms of 10 years. Means this policy is for 10 years. At least I should take the policy for 10 years. So the Pradhan Mantri Vay Vandana Yojana LIC pension scheme offers the beneficiary a assured sum return of 8%. As I was saying, suppose up till the last year, the bank were offering the rate of interest of 4% only. So, but the scheme, if you deposit 15 lakh rupees with the LIC, they will assure you under the scheme 8% per annum on your deposits, right? So, you are assured of 8% return on your deposit of 15 lakh rupees. So, this pension or return will be payable for a period of 10 years. The beneficiary can choose the tenure of payment. If I want to take for a longer period, right, I can opt that, but is payable for a 10 years period, right? An individual can invest up to 15 lakh rupees, I have already spoken about it, maximum, and 1,000 minimum in this plan. In case if the beneficiary dies before the completion of the tenure, the principal amount will be credited to the nominated beneficiary account, right? So up to your lifetime, the amount will be fetching the interest of 8%. After the lifetime of the the nominee will be getting the money that is being deposited. In case of critical illness, the beneficiary can opt for a premature exit. See, the policy is for 10 years. But in case, if there is a critical illness, in that case, the premature exit can be taken, but there is some certain penalty that varies. Normally it is 2%, I am generalizing. So in such cases, 2% penalty charges will be deducted. This scheme is exempt from GST. There is no GST. Other very important scheme is called Employees Pension Scheme. This is very important, widely prevalent in the private sector. So the EPS pension scheme has introduced by the government in 1995 and is also called the Employees Pension Scheme 1995. The EPS scheme was launched by the Employees Provident Fund Organization, which is popularly known as EPFO, and its main aim is to provide social security to the employees. The old pension scheme provides pension to the employee working in the organized sector and their retirement, right? So there are different type of EPS or EPF pension scheme. I am not elaborating in this lecture, but what I have discussed is that different type of pension plans that have been introduced by the Government of India, which gives a regular flow of income to the individuals, and friends, especially those people who are not entitled for, means even after the 2004, that when the government of India stops the regular old, which we popularly known as old pension scheme, now in the new pension scheme, that is the government of India has introduced a new pension scheme after 2004, especially I am talking of the central government, right? And people who are working in the unorganized sectors, they used to face lot of hardships. So at least a regular flow of income can be generated for them. For this, the government of India, and there are certain other schemes which are being introduced by various companies, various fund managers, right, which is being regulated by the regulator of the insurance, right. So these schemes give you a flow of income. With this flow of income, the employee can have a livelihood and can maintain the standard of living which the individual used of, and which the individual used to do during the working life of the individual. So friends, we will continue with this on our retirement planning lectures in my next lecture also. Thank you very much.